The world has a natural law, which is the law of cause and effect. When there is an action, there is an equal and opposite reaction. We have seen high inflation in the past months, which is not showing signs of stopping soon. So much paper money has been printed daily. What do you think would be the reaction to that? A crash, obviously. Everything goes down to the bottom and we are back to square one. Hunger, pain, loss of investments, loss of jobs, loss of savings and family plans, and struggle to survive. We are going to be starting all over to save ourselves. Back in February, plenty of investors were betting that the buildup of Russian troops on Ukraine's border was no more than an elaborate bluff. The Russian and Ukrainian currencies appreciated as hedge funds and private equity firms, signaling their faith in some form of peace deal emerging, confidently bought rubles and the Ukrainian hryvnia. Today there is a war going on that has effectively locked up the raw materials and food usually exported by both nations, and no one knows when the conflict will end. Let us dive deeper into the impending economic crash, what went wrong, and if there is a way for a soft landing. Don't forget to leave your comments below, hit the like button, and subscribe. It is clear from the collapse in global stock markets and sliding cryptocurrency values that investors are panicked by the uncertainty. Shares in the U.S., where the S&P 500 index is down by almost a quarter since January, have suffered their worst start to a year for 60 years. We have seen panics before, notably after the 2008 crash. Investment firms, despite their reputations as the clever custodians of pension fund money, always press the sell button at the first sign of trouble. Collectively, it leads to a rout. Seasoned policymakers know how to react in such uncertain times, and that is to do whatever it takes to assure investors that their money is safe. Western governments have dipped into their reserves, and when that well of cash has run dry, borrowed heavily to maintain a stable outlook for their economies. Vital support has arrived in the form of cheap borrowing from central banks. With low interest rates acting like the cavalry in a John Wayne film, everyone has been able to rest assured the panic will be short-lived. Not anymore. This time there is a real war, not just a financial one, and no one quite knows what to do. The major powers cannot agree on how to fight it, and policymakers cannot agree on how to handle the fallout, especially the shortages of raw materials and food from Ukraine and Russia that are pushing inflation to 10% and beyond. In particular, central banks have lost their nerve. Instead of being a reassuring presence, they are adding to the cost of borrowing. As one analyst said about the U.S. central bank's decision to raise interest rates by 0.75% in June, some analysts believe the base rate will increase to 3% by the end of next year after Threadneedle Street put tackling inflation above sustainable growth. In Britain, this argument presumes that the average worker, to prevent a fall in personal living standards, will be able to negotiate a pay deal that beats the Bank of England's latest forecast for peak inflation later this year of 11%. When the government is expected to limit public sector pay rises to between 0% and 3% this year, that means private sector increases would have to be even higher, about 12% or 13% on average. These levels of pay rise are fiction. Worker power, apart from in some discrete pocket of the labor market, is a mirage. Yet the banks look likely to press ahead anyway, which leaves anyone looking for reasons to remain confident turning to a Rishi Sunak. Compounding the damage from the COVID-19 pandemic, the Russian invasion of Ukraine has magnified the slowdown in the global economy, which is entering what could become a protracted period of feeble growth and elevated inflation, according to the World Bank's latest Global Economic Prospects report. This raises the risk of stagflation, with potentially harmful consequences for middle and low-income economies. Global growth is expected to slump from 5.7% in 2021 to 2.8% in 2022, significantly lower than the 4.1% that was anticipated in January. It is expected to hover around that pace over 2023 to 2024, as the war in Ukraine disrupts activity, investment, and trade in the near term, pent-up demand fades, and fiscal and monetary policy accommodation is withdrawn. As a result of the damage from the pandemic and the war, the level of per capita income in developing economies this year will be nearly 5% below its pre-pandemic trend. The war in Ukraine, lockdowns in China, supply chain disruptions, and the risk of stagflation are hampering growth. For many countries, the recession will be hard to avoid. Markets look forward, so it is urgent to encourage production and avoid trade restrictions. Changes in fiscal, monetary, climate and debt policy are needed to counter capital misallocation and inequality. Developing economies will have to balance the need to ensure fiscal sustainability with the need to mitigate the effects of today's overlapping crisis on their poorest citizens. Communicating monetary policy decisions clearly, leveraging credible monetary policy frameworks, and protecting central bank independence can effectively anchor inflation expectations and reduce the amount of policy tightening required to achieve the desired effects on inflation and activity. The current juncture resembles the 1970s in three key aspects: persistent supply-side disturbances fueling inflation, preceded by a protracted period of highly accommodative monetary policy in major advanced economies, prospects for weakening growth, and vulnerabilities that emerging market and developing economies face concerning the monetary policy tightening that will be needed to rein in inflation. However, the tightening will not last long. Fundamentally, the economy is the weakest it's been since the early 80s in the demographic cycle. They've been pumping this up, and if they haven't overreacted with COVID, they wouldn't have to tighten here. I think it's going to burst. This thing, by the end of the year, we are going to be in a deep downturn that is going to take a couple of years to wind out the stock markets that's already peaked. On January 4th, the S&P, November 22nd for the Nasdaq, and November 8th for the small caps. We are just seeing the first crash, which usually is 30 to 40. You don't know the bubble's over until you get the first crash that hits hard, 30-40%. So if you think your stockbroker is telling you, well, just sit through this and the market will always get a new high, you will be bitterly disappointed. This will be an everything crash like 2008, only much more. You simply have to get out of the way. It is going to be a crash of a lifetime. Are you ready for the crash? Let us know what you think about the global crash in the comment section below. Don't forget to hit the like button and subscribe. Thank you for watching.